Indian equities have weathered volatile market conditions in 2022 when the majority of global indices failed to earn returns. Nifty and Sensex have risen about 3% year to date, while most global indices are in red. The MSCI India Index, which is used by global investors to assess the performance of Indian equities, has outperformed the MSCI World Index by 20% in 2022, the highest in 8 years. Now, as investors, we have gone through a turmoil of events, namely soaring commodity prices fueled by Russia-Ukraine war, followed by fast-paced interest rate hikes that have brought many economies to the brink of recession. Now, Indian markets too were hit by the global gloom. Nifty hit a low of 15,293 points and dropped by nearly 13% year to date. However, it has surged 19% since then and it has crossed the 18,800 mark. Now, domestic investors have played a key role contributing to Indian equities, while the FIIs or FPIs have offloaded. The fundamentals of the Indian economy have seemed to change for the better as the country became the world's fifth largest economy, surpassing the UK. Additionally, foreign investors are treating India as a preferred destination. Economic reforms in the form of production-linked incentive scheme, national logistics policy have also boosted investor sentiment. Now, improving corporate earnings and improving asset quality in the banking sector have also led to a positive sentiment towards the Indian corporate sector. While I say this, do watch this week's Third Empire episode presented by our whole-time director, Mr. Sanjeev Anand. He will take you through the events that occurred in 2022 and lessons we've learned in a very difficult year. A current account deficit occurs when a country imports more goods, services, and capital than it exports. Now, in the quarter that ended in September, India's current account balance showed a deficit of $33.4 billion, which increased from the previous quarter's 2.2% of GDP to a 9-year high of 4.4% of GDP. Now, the widening of the merchandise trade deficit and an increase in net outgo under investment income were the main drivers of the current account deficit in quarter 2. This also outweighed the higher than expected service surplus and secondary income flow. Now, a country experiences a current account deficit when the value of its exports of goods and services and other revenues exceeds the value of its imports of goods and services. Now, a trade deficit is normally the largest component of a current account deficit. Now, the moderation in exports and the growth in imports have led to a high trade deficit for the country. Hence, India's current account deficit is now pressured. Now, there are a number of reasons why exports have moderated and the outlook is likely to remain challenging in the foreseeable future. The drop in momentum in exports is driven by the intense global headwinds. The global economy is slowing, which is affecting demand. Now, imports have been growing faster than exports, which is also leading to the trade deficit widening to record levels. So what does these news mean for you? While the next year won't come without challenges due to macroeconomic headwinds, India does present a secular growth story, and the outperformance by the Indian markets clearly shows it has a distinct advantage over others. This will have an indirect positive impact on you. While we believe India won't be adversely affected as we have ample foreign exchange reserves to withstand any kind of pressure, we do believe that growing trade deficit and current account deficit is an area of concern for the country. This will have an indirect neutral impact on you. While I say this, is me, Merlin Susanna, signing off, wishing you and your loved ones a very happy new year.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.